Hey, everybody, and welcome to another episode of Engineering Money, the podcast where some full-time engineers give their 2 cents on the financial news of the week. My name is Ben.
Ben, I didn't realize you'd started it
Well,
already.
we're going.
All right,
Yep.
No
well,
turning back now, Tim.
I'm reporting here. Oh, my name's Tim. I'm out in the wilderness today. It's pretty cold. It's 27 degrees, but I'm on site,
Where?
so I think this is in Bryce
Oh.
Canyon. Yeah, pretty neat.
Very neat. I'm Joey. I'm still in my basement, but it's also 27 degrees. Not inside, outside.
Yeah, I'm reporting here from Seattle where it's 48 degrees, 46 degrees, and it's not raining. So that's kind of cool.
Impressive.
Yeah. So, all right, second episode of the new year. Things are going
we
very
did so
strong,
well last week.
especially Joey.
Yeah.
Yeah.
Joey's first week, he was up 20%.
Yeah, if you didn't tune in last week, you should, because that's when we picked our top 30 stocks for the year. Each of us had 10, and it's going well.
Yeah, but you cheated. You chose like a bunch of hype stocks.
We'll see how it
Yeah,
nets
we'll
out
see how
by the end of the year.
sustainable
That's
the
what counts.
20% a week goes over the course of the
Yeah,
year.
'cause it doesn't matter if they're 20% now and then crash by 50%.
Yeah, that's true.
Well, awesome. So we had the finalizing election stuff this past week, solidifying Joe Biden as the president, and with the runoff election in Georgia, the House and the Senate are now controlled majorly by Democrats. So that's pretty.
Mm-hmm.
It's going to be wild. So
And
Magic
we've talked
three.
about it in
we've
the
talked
past.
about it in the past, and so I did a little more digging, and I found this from the Barons and also just from looking. This is the 10 instances since World War II that the Democratic Party has controlled everything by a majority. So we got the start, the end date, how much majority they had in both the House and the Senate, who was the president, and then how the Dow Jones performed over the 2 years of those controlling terms. And I'm wondering if that source that we were showing earlier is inaccurate, or there was a different scope. Maybe it was the year that they
Right.
started or something, but according to this,
Because we saw
5% average
on
growth.
average.
But I mean, there's only 2 years where it went down, and then there's 5 years that were over, or I'm sorry, 5 terms, which is 2 year period, that go over 20%.
Yeah.
So what's the average, and then half of that?
I don't know. I didn't do that, Joey. I can't do all your work for you. But I will say the amount of the margin is the lowest that we've seen in anything since World War II. So they're in control, but it seems like by the least amount that they have been.
I
Yeah,
see.
you were saying, who was it under where they had like?
Yeah, there's this one term where Johnson was the president, where 86 seats were Democratic in the Senate,
But the Dow went down.
and the
that
Dow
year,
went down that year.
for those
yes.
2 years.
But that
Wild.
clearly it doesn't have anything to do with that, because
Yeah.
the previous 2 year period when Johnson was president, 84 seats of the Senate were Democratic, and the Dow Jones went up 33%.
So Ben, are you saying that we don't really know what's going to happen?
Past performance isn't telling us what the future is going to do. It's never
Past
happened in
performance
history
isn't
before.
Even anything. There is no past performance. It's all random.
But I mean, I don't think there's any reason to be scared to think that the markets
Yes.
are going to go
So
down.
that's one
Just because
thing
of this situation, yeah.
I guess the moral of the story here is just because the Democrats are controlling everything doesn't mean apocalyptic doomsday scenario in terms of market performance. Because
Yeah.
8 out of the 10 times it's happened since World War II, we've been okay. And they've had much larger majorities in these past 10 instances than we see right now. So I think we'll be okay.
Yeah, and speaking of like just foreign relations, well, not foreign relations, but speaking with the current administration, they were considering adding Alibaba, Tencent, and just those two to the investment ban.
Okay.
Like those, yeah, which I think has not boded well in like the past 2 months for Alibaba's price, and they're actually down quite a bit. Maybe you want to pull that one up.
Yeah, let me
Ben.
do that.
Well, and Ben, while you still have this screen up, I went ahead and did that math, and it looks like the average growth was about 15% over a 2-year period.
So nothing to gripe at.
Oh yeah, look at this.
Which is, yeah, that's pretty. I guess it's a little bit lower than average Dow growth historically, but it's pretty normal.
Yeah. Yeah, but Alibaba, their high was like 320, and now they're at 230.
Yep, 236.
Just because I mean, if a company is at threat of being delisted, you don't want to hold that stock when it's delisted.
Right.
It's like you can't sell the shares. Do you even own them?
And again, that's why I'm so hesitant to have any Chinese stocks right now. And a lot of investors feel that same way.
Yeah, but then NEO's making you think twice, right?
No, not really.
Okay. But I think I don't think that a Biden administration would delist them.
I see.
So it's still a gamble.
Yeah.
But if you don't think that Alibaba will be delisted, they look like a great buy right now.
I think the key factor will be which side of the aisle was leading the charge for the ban, which I don't know. But it's pretty straightforward. If it was the Democrats, then it probably will go through. But if it was a Republican push, then maybe not.
Maybe not. Maybe it still would though.
But this is like, if you're an options trader, buy like a straddle or a strangle that's really wide, because the stock isn't correctly valued right now. It's either about 0 or about 340.
Yeah.
So
you're right. It's either 0 or 340.
Right. So you don't have to think, oh, maybe it's going to land in between. It won't. It's going to either bounce back or go to 0.
Well, so this sort of research got me thinking how we can go about making investment decisions based on policy plays that might be dominant over the next 2 years, since there really is nothing holding them back getting things out. So the 4 policy plays that I thought of were the obvious one is clean energy. There's going to be some massive pushes over the next 2 years to get clean energy, big infrastructure spending bills. I know there's already one that's looking to pass a few $1 trillion, I'm pretty sure, for infrastructure repairs. Cybersecurity is always a good buzzword. And then because of how quickly this administration is planning on pushing out the vaccine and getting it out as quickly as possible, we might see the return to normal type things. Not so much in quarter 1 or quarter 2, but definitely by quarter 3 and 4, we're going to see the resurgence of things coming back.
Yeah.
And go for it, Tim.
With clean energy, I mean, we talked about this quite a bit last week. I'm hesitant to pick any one company because clean energy can be booming, but you could still have a mismanaged company. So I prefer to do an ETF, which ICLN.
The other
I
one
think.
is QCLN. Both of them are good picks.
Yeah, you wouldn't let me pick it last.
I know,
week,
because we weren't doing ETFs.
Yeah. Whatever. Okay, but infrastructure. I only remember this stock because of the ticker, which is ROAD.
Road. Oh yeah, I like Road.
They're at an all-time high right now, but their price to sales is only 2.21.
Whoa.
Which is pretty low.
They're pretty. It could be undervalued.
Their PE is 43, but they're a pretty new company, or they've pretty recently been listed. So maybe, I don't know. Are they like a growth stock kind of?
What's their price to book?
What?
What's the price to book?
4.5.
It's. I feel like that puts them in growth stock territory, but just barely.
Yeah, but the price.
Crazy price to books.
The price to sales though is what got my attention, because that means they're not like. They can be reinvesting in themselves a lot, like 'cause you can get a high PE, but it's just you're dumping all of your profits back into the company.
But the thing, so their PE estimate for this year is 30, but the industry average is 173.
Oh.
So, I mean, based on the S&P Global Market Intelligence valuation, they are right in the middle of the road, just 50th
get it
percentile.
Because you said road.
Yeah. Yes.
Yeah.
But for something that looks as growth trend as this, being in the middle is a good place to be.
The other one I thought of was Vulcan Materials. So looking more on the supply side. If there's a lot of infrastructure stuff going on, they're going to need a lot of material. We're talking like the construction aggregate stuff like asphalt, concrete, copper, all steel, things like that. Infrastructure needs a lot of stuff. So this Vulcan Materials, they do all sorts of construction aggregates. They're looking pretty strong, especially if there is a massive infrastructure bill that comes into play this year. And then the other thing too with copper, the supply side is looking a little rough and weak with copper. From what I saw, it's looking like the industry is kind of consolidating into less and less companies, but demand is rising. So we might see a massive shift in how copper looks this year. So
I don't really follow copper.
Yeah, so I like...
when you say massive shift, what way is it going to go?
Oh, it's going to go up.
Yeah, tell us exactly where it's going to
be. If we're talking supply is looking weak, but demand is only going up, and will probably go up even more this year, it's going to be harder to find, but more people want it. So it's going to go up. And the one ticker that I like, Turquoise Hill Resources. This is Mongolian copper.
Turquoise Hill shill.
Mongolian copper. They recently did a split, 1 to 10, so they're at a, what would you call this? Like a,
what price?
They're $14.50. It seems like a legitimate stock. I'll say that, because when it was sitting at less than $1, people are kind of weary of that. But now it's at a comfortable level.
Wait, did they do a reverse
yes, they
split? Did. Oh, Ben, that's never a good look for a company.
Well, take a look at their performance since they split, or I guess reverse split. When they split, they were at 80 cents, and then they went up. It was a 10 to 1, I guess. So they were just at around 80 cents, and now they're at, I guess it would be $1.45 or something like that. So
I'm unconvinced.
I guess people didn't care.
People didn't care. The company looks
Unless when was that split announced? Because you see that big drop there. Maybe that's when they said, "Hey, we're going to do a stock."
Well, that big drop was March of 2020.
Oh, okay. Never mind.
Well, also, a lot of institutional investors can't invest in stocks that are like less than $10.
I'm telling you, it looks legitimate now. Before it was under $1. People didn't mess with that sort of stuff.
It definitely makes a
Yes.
difference. I mean, these little things are just, if it's easy to invest in, it's a nice price point. It makes a difference. Just
Mhm.
like the stock ticker
Yes.
matters. Like people invest in things just based off the name.
Road.
So, yeah,
Okay, and then I got one more thing,
definitely
if
something.
you guys allow me to.
Well, Ben, first let me. I want to tell you why Vulcan is going to be a
Oh
big
yeah.
play.
Hmm.
It's because along with the big infrastructure bills that can come in, the new Secretary of Transportation,
Oh,
who's probably going to be the new Secretary of Transportation, is a big Star Trek fan. So Vulcan, I'm pretty bullish
Nice.
on that.
Very cool.
I like the
Yeah.
reasoning.
So the other policy play that I mentioned was return to normal, and I know everything looks really rough in terms of like entertainment, leisure stuff, transportation, like airlines,
Mhm.
things like Disney. It's hard to really say. So there's one ETF that I found that I like, the Invesco Dynamic Leisure and Entertainment ETF.
Ooh,
Dynamic
what's the
leisure.
ticker?
PEG. No, PEJ. I don't know how to read. But you see that massive
Hedge.
decline in March, thanks to the pandemic. But they pay out a dividend, and they've been trending up since that drop. If leisure and entertainment stocks, if there's a return to normal, they're going to hopefully do better this year.
Right. You'd think they kind of at least deserve to be where they were
Yep.
before March, if everything's going back to normal.
I mean, where they were before March was $45 though.
So they've almost had a.
They're already back at
But
41.
you also-
Maybe they could go up
You
even
also
higher.
have to remember
It's still
that
a 10% gain.
this ETF, it's professionally managed, and they could, be, and since it's dynamic, there's probably like
Mhm.
they've been making plays since the fall that's helped boost their numbers.
Yeah, but Ben, what do the professionals know?
See, yeah, and then that's the greatest thing about the ETF is you kind of like get to sit back and like let a trained person that knows more and deals with it all day every day make the decisions for you. So that's all I had.
True.
Okay. I wanted to talk about a bit more.
Oh, but before
oh,
that, Tim,
what?
aren't we sponsored?
Oh, yeah, we're sponsored by Vinovest. If
Another
you're interested
surprise.
in wine investing, then go check them out. We got a link in the description. You can buy some wines, and then I don't know. You can keep them and hope that they gain value, or you can drink them.
Boom.
It's very cool.
And
Also, I've never
I read
mentioned this before, but they send. Well, it's not really relevant during COVID, but they send out like if you're an investor with them, they send out invites to like these wine mixers.
Very
you
nice.
Can, you can
That's
attend only if you're a Vinovest investor. How cool is that?
That's pretty upper class.
Yeah.
But I was actually just reading on the I think it's the stock market subreddit,
Mhm.
and someone was talking about technical indicators and when are they useful, and you mentioned specifically like fine art and wine and stuff, and it's like technical indicators aren't going to help you here. You really need to have insider information and know people and know the major players and what's going on. And I don't know, that to me said, oh, so maybe instead of trying to do that myself, I should have a professional like Vinovest. Seemed like a kind of good idea.
Yeah. I just.
All right, Tim.
I think it's fun.
What are you talking about today?
Oh. Payrolls dropped for the first time since April.
Where's the confetti?
Does that
Woo!
bode badly for the future? Maybe. Does it not matter? But unemployment steadied at 6.7%.
Which is not awesome.
I mean, it's not terrible.
It didn't
though,
go down.
to be honest.
Right.
So is a
That's-
plus?
Yeah, it can go down, which gives good upside. But also, like, I don't know, like we were at 3.5% unemployment. That's crazy low.
Right. That was like record low.
Yeah.
Thanks, Obama.
So, um, yeah, and then I'm gonna be quick here. Uranium.
Bombs.
Supposedly Ben brought up uranium. Why'd you bring up uranium a few
So
weeks ago?
I was talking about the hype train of electric vehicles. Wait, is that right?
Mm-hmm. Maybe. I don't remember.
I thought it was the episode that I was talking about sort of the whole production chain of EV. But maybe it was something else. I can't remember. I brought it up, though. You're right.
It doesn't matter, I guess. Yeah. So nuclear power is actually gaining popularity
Boom.
again.
We love to see that.
And so it might be good to start to get on uranium mining companies. Now, I don't know which one would be good, but there's a ETF that I saw, URNM. But the thing is, I don't think it's too... Like, we still have a ways to go before there would be a run-up with any sort of uranium stocks, because it takes a long time to get that supply chain going. You need to secure a supply of uranium years in advance for a nuclear power plant.
Oh.
So, you know, we're still at the early stages, but I think it's definitely something to watch. And that's pretty much all I have.
Neat. Well, the stuff that I wanted to bring up was just relating to how, for the past, how long has this rally been going on? I'm like looking at the S&P 500 here. I feel like it's been pretty steadily trending up since November, and this last week was no exception. And I don't know, I've been getting nervous about it because we keep talking about stuff that, I don't know, this is a theme with me. I get nervous all the time, and it's going up, and then we had this big the big mob situation at the Capitol, and
yeah,
I remember seeing that news report come out and watching stocks tank, but they just as quickly bounced back up. And to me, I'm thinking like, okay, I'm nervous. Last week, I just brought up a bunch of stocks that I hope to do well in the coming year, but they were all big growth stocks that everyone knows the name of because they're meme stocks. And so I started looking into, okay, what are some maybe less discussed, higher value stocks, or I guess or better valuation stocks. And so that's what I went hunting for. And I have 3 to bring up that you may not have heard of. The first one is BIG, BIG.
Now that seems big.
And it's
big.
This is big news.
Oh, big lots.
Yeah, it's big lots.
Wait, what? Joey, I don't trust big lots.
You don't trust big lots. How can you not trust them? But they are just incredibly undervalued right now. Their price to earnings, for example, is at 5.79 compared to the industry average of 66. They're giving out an almost 3% dividend, which is only 8% of their earnings per share. So they're like, they could easily increase their dividend. And they just like in the past 52 weeks are up 50%. So I see undervalued stock, looks like they're going to keep growing and has the stability of a good dividend under them. So that's why I think big lots, it would be a good balance to the 10 stocks that I pointed out in my portfolio. I still think that those ones are going to the moon, but if you're nervous by investing in NEO and Plug, then maybe take a look at big.
But Joey, here's one counterpoint. I've never been in a big lots store. How? Yeah.
I don't
how am
think
I
I've
supposed
been
to
in one
invest
either.
if they haven't been aggressive enough to put into big lots near where I live and lure me in as a customer?
That seems like a personal problem.
Well, yeah, maybe you should check out big lots.
Maybe.
All right, what are the other 2, Joey?
Okay, the other other two, first one is MDC, which is MDC Holdings, and I've been thinking
What do
about.
they do?
So they basically focus on first-time home buyers and do a bunch of stuff for them, including mortgage loans. They also build homes. They have a bunch of, like, a basket of real estate related businesses that they deal in. And I just remember when I bought a house this past August and thinking, like, okay, I have my realtor and then my mortgage lender, and then you got your home inspector, and you got whoever built the house. And wouldn't it be neat if, like, one company did all of these things? And this is kind of like that. But they similarly hit a lot of those marks that Big Lots does, where right now they're giving out 3.5% dividend, which is only a third of their earnings. So plenty of room for growth there. Their PE and valuation puts them right at the kind of the middle of the road, just like road. And they look like, I mean, Ben has the ticker pulled up right now, but it's kind of like any Dow Jones looking graph where they took a dip in March, they've been coming back up, nothing astronomical, but again, we're looking for stability in these, and I think this one has that, especially because real estate and just housing is really hot right now with mortgage rates as low as they are. So, and I don't think that's going to go away anytime soon.
But the last of one, housing, Toll Brothers is looking pretty tasty right now.
Let me pull them up real fast, just because.
Yeah.
I think I was the one that mentioned them a while back. Yeah.
Yeah.
Toll.
They're pretty tasty.
I like that name.
All right, what's the last one, Joey?
So the last one is ADP, which is Automatic Data Processing Inc. It's an information technology stock.
Yeah, ADP's the one that... Wait, aren't they the ones that always do the jobs things?
Yeah, I think that's it, because they are probably the oldest company in the information technology sector. Because you think of things like, I don't know, Facebook in there. But this company was founded in 1949.
I believe it.
And they mainly handle payroll and stuff, right?
Yeah, and things like human resources, hiring companies, payroll, stuff like that. But they are one information technology stock that, over the history of their existence in the stock market, grows exponentially like information technology tends to do. They've been struggling for the last year, but for kind of those same metrics I mentioned on the other two stocks, these ones look pretty tasty right now. Almost 4%, or no, I'm sorry, almost $4 a share dividend, which is 2.17% dividend.
We better not start using that consistently now.
What?
Saying that a stock is looking tasty.
Looking like a snack.
Like the whole damn meal.
But yeah, so those are three stocks that I am bullish on now for I don't know the exact timeline that they may be good, but I'm thinking relatively long term, like over a year, they should be looking pretty good.
Well, cool.
But yeah, that's all I wanted to bring up.
All right, end it quick before we get to 30 minutes.
Okay, bye everyone.
Sleep good.
Okay, bye.